Welcome back to Investing Talk podcast. Today we're tackling a question that's likely on a lot of investors' minds. Is Carlyle Group a good time to buy now? We've looked closely at the latest financial reports, market data, analyst insights, the works to give you a clear overview. We want to help you understand what's really happening with this global asset manager. Our mission really is just to pull out the most important bits from all these sources so you walk away well-informed, maybe even a little surprised. And before we really get into it, if you find these insights valuable, please think about subscribing, liking, maybe leaving a comment. It genuinely helps us bring more of these analyses your way. You could also buy us a coffee to support the work we do. And hey, if there's a specific company you're curious about, just drop it in the comments below. All right, let's unpack Carlyle Group. When we look at their most recent numbers, that Q2 2025 quarterly statement, what's it telling us about the company's fundamental health?
Yeah, it's interesting. Looking at the trailing 12 months, that's the last 4 quarters combined, Carlyle reported revenue of about $2.17 billion and net income around $563 million.
Okay.
Now, while revenue did show some modest year-over-year growth, which is positive,
Yeah.
the net income margins, they're definitely facing some pressure.
Ah.
But this isn't just a Carlyle thing, It's pretty common across the whole alternative asset management industry right now.
Really? Why is that?
Well, it seems to be driven by a few things. More competition for deals, definitely. Higher funding costs with rates where they are. And you also have investors pushing a bit harder for lower management fees.
Right, the fee compression issue.
Exactly.
Yeah.
So firms like Carlyle kind of need to innovate, maybe change up fund structures or go after bigger, more complex deals to keep profitability up.
So they are growing, that's good, but it's getting maybe harder to make the same profit on that growth. Given those pressures across the board, what are the forecasts looking like for Carlyle's revenue going forward? Is this kind of modest growth what we should expect?
Well, the expectation is actually for them to maintain mid-single-digit revenue growth, sort of in that 4–6% range.
Okay.
And that's largely supported by how diversified they are. Private equity, credit, real assets. It spreads the risk.
Right, that diversification acts like a buffer.
Exactly. It helps insulate them from, say, one sector having a really bad time. But, and this is important, those forward earnings projections, they really hinge quite a bit on overall market sentiment and how their assets get revalued. It introduces a bit of uncertainty, always does.
Makes sense, like trying to predict property values.
Kind of, yeah.
Okay, moving from income to the balance sheet then. How solid is Carlyle financially? What's the debt situation look like? Cash on hand? These are always crucial.
Sure. So at the last quarterly close, they reported total debt of about $5.2 billion.
Okay.
And cash equivalents stood at $2.0 billion.
Boy.
But crucially, their operating cash flow is still positive. It was $958 million for the trailing 12 months.
That sounds pretty good, positive cash flow.
Yeah, it shows the core business is generating enough cash to cover things. It provides a decent cushion.
Okay, positive cash flow is definitely a strong point, but it makes me think about, the elephant in the room, rising interest rates. Could that debt load become a bigger problem if rates keep climbing?
That does raise an important question for you, the investor. Those debt maturation schedules, they could definitely require refinancing down the line. And if rates stay high or go higher, that refinancing will cost more. That's a real consideration. However, looking at their leverage ratios, how much debt they use compared to equity or earnings, they're actually seen as moderate for the sector.
Moderate. Okay, so not excessively leveraged compared to peers.
Right. It means the risk of immediate financial distress seems lower. And importantly, nothing in the recent filings flags an immediate liquidity concern, suggests they have enough cash or access to it for now.
Got it. Now, beyond their own books, Carlyle is in a really competitive field. How do they stack up against the other big names, like Blackstone or KKR? Where do they fit in?
Well, they're definitely up there, among the largest global alternative asset managers, right alongside those names you mentioned.
Okay.
Their competitive advantage comes partly from just sheer scale, deep relationships across markets. That's pretty standard for the giants. But where Carlyle perhaps has a unique edge is in its proprietary deal sourcing.
Proprietary deal sourcing. What does that mean exactly?
It means they have strong internal teams and networks focused on finding investment opportunities before they hit the open market or get widely auctioned off.
Ah, so they get an early look.
Potentially, yeah. Or they find niche opportunities others miss. Some sources pointed to their strength in distressed assets, for example. They apparently closed a strategic deal last quarter in a niche industrial sector at a good discount, showing that capability.
Interesting. So that's a real differentiator.
It can be, yeah. And their diversified funds also help defend against sector downturns.
That scale and deal sourcing sound like strong advantages. But is there, a chink in the armor? I've seen talk about fee compression affecting even the big players. Is that a genuine worry for Carlyle, or can their size just power through it?
No, you've hit on a really critical point there.
Yeah.
Absolutely. Scale helps.
Yeah.
But the whole industry is facing that persistent pressure on fees.
So they can't charge as much.
Effectively, yeah, the percentage they can charge gets squeezed. Plus, you've got more competition, new, maybe more specialized funds popping up.
Right.
They're all chasing the same investor money. So yes, even for a giant like Carlyle, these things can definitely impact profitability and force them to be more efficient or find higher value strategies.
Okay, understood. So we've covered the fundamentals, the competition. Now, the million-dollar question for a lot of listeners, valuation. How does all this translate into Carlyle Group's current stock valuation? Let's look at those traditional metrics.
Okay, valuation. As of August 30th, 2025, based on Morningstar data, Carlyle trades at a price to earnings, or PE, ratio of 19.4.
19.4, okay.
Price to sales, PS, is 4.1, and price to book, PB, is 2.3.
And how do those numbers compare? Are they high, low, average for the industry?
Well, if you look at the broader industry, averages for asset managers tend to fall in a PE range of maybe 18 to 22, PS usually between 3 and 4, and PB from 2 to 3.
Okay.
So if you compare Carlyle's ratios, 19.4 PE, 4.1 PS, 2.3 PB, they're very much in line with those peer averages.
Right in the middle, then.
Pretty much. It signals the valuation is quite fair relative to competitors. Not obviously cheap, not obviously expensive.
So fairly valued, that suggests stability, maybe, but perhaps less room for a quick pop if you're looking for a bargain. What about more complex valuation models, like discounted cash flow? Do analysts see much upside potential from the current price?
Yeah, looking at the consensus DCF models from market analysts, they estimate a fair value for Carlyle somewhere near, say, $45 to $48 per share.
Okay, and where is it trading now?
Right now, the stock's been hovering in the $42 to $46 range.
Ah.
So that implies pretty limited near-term upside based on those DCF models.
So the models basically agree with the simple ratios.
Yeah.
Fairly valued.
Essentially, yes. Based on the current expected cash flows, the stock seems largely fully valued right now. It's like, it's priced appropriately for what it is, not necessarily a steal.
Okay, that gives us the fundamental and valuation picture. Let's switch gears to the technical side. What's the recent stock chart telling us? Any key levels or signals for Carlyle Group right now?
Well, over the past month, the price has pretty much bounced between $42 and $46.
Oh, okay. A defined range.
Yeah, and the day-to-day volatility has mostly just mirrored what the broader financial sector is doing. It's not really forging its own path lately. Key technical levels traders might watch are support around $42. That's where buyers tend to step in.
Right.
And resistance up near $46.50, where sellers often emerge.
Are there any, stronger signals, like from moving averages or momentum indicators? Is it looking like it might break out of that range?
Not really seeing strong signals right now, no. The 50-day moving average is at $44.20. The 200-day is $45.10.
Pretty close together.
Yeah, which often suggests a lack of a strong trend. And the RSI, the Relative Strength Index, it's at 54, which is smack in the middle, neutral. It's been kind of stuck in that 50-60 zone for weeks. No real overbought or oversold hints.
And NANTD?
The MAMI-D indicator is flat too, basically confirms there's no strong momentum signal, up or down.
So the short-term trend is just sideways.
Pretty much. Sideways within that $42 to $46.50 range, and volatility has actually been kind of muted compared to earlier in 2025.
Okay, so the charts are basically saying, wait and see. Let's talk news then. What's been going on with Carlyle Group recently? Any big headlines? How's the general sentiment? Analyst changes?
Well, their last earnings release, Q2 2025, it was a slight miss compared to expectations.
Oh, okay. Why was that?
It was primarily attributed to some valuation markdowns in certain funds. They mentioned challenges in some specific private equity holdings in their investor relations stuff.
Got it.
As for analysts, in August, it was a bit mixed. Goldman Sachs kept a neutral rating, but UBS actually upgraded the stock to buy.
Interesting split there.
Yeah. And beyond that, no major M&A news, no big regulatory headlines this past month that would really shake things up. Relatively quiet on that front.
What about insider activity? Executives buying or selling, or just broader buzz among retail investors? Anything notable there?
Looking at the SEC Form 4 filings, those mandatory insider reports, there was some minor insider selling back in July.
Okay. Is that worrying?
Not necessarily. It's actually pretty typical after earnings come out. Executives might exercise options, sell some shares. Doesn't always signal a lack of confidence, just normal course of business sometimes.
Right.
And on the broader sentiment front, looking at social media and forums, it seems pretty neutral. No strong retail investor push, no activist investor making noise. Things seem calm.
Okay, so neutral technicals, quiet news flow. What could potentially move the needle for Carlyle Group? Short term or long term? What catalysts should investors watch?
Good question. Short term, the big one is the next earnings report. Q3 2025, expected late October.
Right, everyone watch those numbers.
Definitely. People will be looking for any change in those valuations or margin pressures. Also, any Fed rate decisions are key.
Ah, the macro impact.
Exactly. And just broader credit market volatility. The whole sector is sensitive to that stuff. Changes there could move the stock quickly.
And thinking longer term, what are the bigger potential drivers or game changers?
Long-term, continued strong asset inflows into their funds would be a big positive catalyst.
More money to manage.
Right. Also, successfully launching strategic new funds, maybe expanding into totally new asset classes or regions where they see growth, that could be significant.
And the flip side, any long-term headwinds?
Well, regulatory changes are always a possibility. Things like new rules on fee disclosures or stricter ESG mandates, those could impact profitability across the whole industry. It's a constant watch item.
Makes sense. Of course, no investment is without risk. We need to talk about those. What are the specific risks investors should be aware of with Carlyle itself?
Okay, stock-specific risks. Well, that persistent fee pressure we talked about is one. Increased regulatory scrutiny is always a risk in finance. And just the basic difficulty of finding good deals and deploying capital at attractive returns when competition is high.
Right. Finding those good investments gets harder.
It does. And also, there's significant exposure to illiquid asset classes, like private equity. That increases their risk during market downturns.
How so? Harder to sell.
Exactly. Think about trying to sell complex private assets quickly if the market tanks. It's not like selling liquid stocks. You might have to take a big haircut on the price, or you might not be able to sell it all for a while.
Gotcha. That definitely heightens cyclical risk. What about broader market risks? How sensitive are they to the big picture?
Very sensitive, really.
Yeah.
The firm's performance is tightly linked to credit markets and interest rate cycles. Changes there directly impact their borrowing costs and deal-making ability.
Okay.
And just general market drawdowns, big stock market sell-offs, those can directly hit the net asset values, the NAVs, of their underlying portfolios. That impacts their performance fees and overall results.
So their fate is pretty tied to the overall economy and market health.
Very much so. Their performance is often seen as a kind of bellwether for the financial sector.
Okay, we've covered a lot of ground. Fundamentals, valuation, technicals, news, risks. So pulling it all together, what does this mean for you, our listener, maybe thinking about Carlyle Group right now? What's the overall investment thesis coming out of all this?
Based on analyzing all these sources, we'd give Carlyle Group an overall rating of, say, 6 out of 10.
6 out of 10, okay.
Look, it's undeniably a leading global player, solid fundamentals, strong competitive position, especially with that proprietary deal sourcing we mentioned. But its current valuation just looks fair. It doesn't seem to offer much near-term upside potential because it's already considered pretty fully valued based on current forecasts.
So not likely a quick win then. It sounds more like a be patient kind of stock right now.
Exactly. That sums it up well. The technicals are neutral, right? No strong momentum. And there aren't any obvious major positive catalysts expected just around the corner in the next quarter that looks set to dramatically change its path. Which really brings up that key question for you, the investor. What is your investment horizon? Are you thinking short-term or long-term? Because that really dictates whether this fits.
Okay, so based on that, what's the final recommendation for our listener? Who is Carlyle suited for?
Well, Carlyle Group seems best suited for long-term investors. People seeking steady, consistent exposure to the asset management sector.
Someone who wants a piece of that industry and is okay with potentially slower growth.
Precisely. Investors comfortable with the solid fundamentals and competitive position, but who aren't necessarily chasing rapid gains. Short-term traders, on the other hand, they probably won't find much excitement here right now. Limited volatility, no clear price momentum until something significant changes.
So definitely a marathon, not a sprint, as they say.
That's a good way to put it.
Okay. So the bottom line on Carlyle Group, based on our analysis today, it's a solid, well-run company in a key sector, but maybe one for the patient, long-term portfolio builder. It really comes down to where it fits in your overall strategy, especially if you value stability and alternative assets over chasing quick returns. We really hope this look into Carlyle Group has helped give you a clearer picture. And please don't forget to subscribe, like the video, leave a comment with your thoughts, or suggest other companies you'd like us to look into next. That feedback really does help us. And as you mull over Carlyle Group, maybe think about this. How do these huge diversified asset managers actually influence the broader economy? When firms like Carlyle deploy billions, what are the ripple effects on innovation, on jobs, maybe even on the cost of things we buy? And what does their strategy tell you about navigating your own investments in such an unpredictable world? Lots to think about. Until next time, keep learning and keep investing wisely.